When you click Pay in 4 at checkout and that $200 jacket suddenly becomes just $50, you're part of a $500 billion debt bubble that's starting to crack. The stores you shop at are seeing their profit margin shrink just to let you split the payment. So they add to prices across the board. That's a hidden tax on every single thing you buy. You should stop calling that a free payment plan because everyone's paying for it. One of the key BNPL players lost 99 million last quarter. Another one burned through 1.3 million every single day last year. 3 other companies collapsed in the last year. OpenPay left merchants with $18.2 million in losses. Laybuy's failure hit 4,200 businesses. When Kiwi Bank faced $30 million in exposure from just one BNPL company, they realized this isn't sustainable. The way you pay for everything is about to dramatically change, because what started as a clever way to afford things has become a financial time bomb, and you need to understand it before it explodes. Buy now, pay later didn't appear by accident. It emerged from a perfect storm of financial crisis, technology, and changing consumer behavior. The 2008 financial crisis fundamentally changed how banks viewed consumer credit. Credit card approvals plummeted. Young adults watched their parents drown in 29% APR credit card debt. They wanted something different. But the real accelerant came in 2020. The pandemic shifted the world online overnight. E-commerce jumped 5 years forward in 3 months. Everyone was shopping from home, flush with stimulus money. But psychologically scarred by uncertainty, BNPL was perfectly positioned. The pandemic didn't create the pressure, it revealed it. When rent goes up 20%, but salaries rise 3%, people get desperate. 64% of Americans now live paycheck to paycheck, including 6-figure earners in expensive cities. BNPL didn't create this squeeze, it exploited it. Swedish company Klarna launched in 2005, but remained small until these forces converged. Then everything changed. In the US alone, BNPL volume exploded from $2 billion in 2019 to $24 billion in 2021, an 1,100% increase. In just 2 years, the industry grew 12 times larger. That's not organic growth, that's a gold rush. When you buy now, pay later, you're not the customer, you're the product. BNPL companies are selling more sales, and it's delivered to merchants at 6% premium. The psychology was brilliant. Traditional credit cards remind you of debt with every monthly statement. You see that balance, you feel that weight. BNPL reframed the narrative. This wasn't debt, it was smart budgeting. The numbers prove the psychological shift worked. BNPL increases average order values by 30%. People spend nearly a third more just because they can split the payment. For retailers, the math seems simple. Pay 6% in fees, get 30% more revenue. What could go wrong? Everything. The business model had one fatal flaw. BNPL companies make zero money from consumers who pay on time. No interest, no fees, nothing. Their entire revenue depends on 2 sources: merchant fees and late payment penalties. Klarna alone collected $254 million in reminder fees last year. This creates a perverse incentive. BNPL companies need you to use their service repeatedly, but they also profit when you fail. They've built a business model around that, and the psychology is brilliant. Traditional credit cards remind you of debt with every monthly statement. You see that balance, you feel that weight. With BNPL, it's not in debt, it's smart budgeting, right? By 2021, the average BNPL user had accounts with multiple providers. The stage was set for what researchers now call the normalization of continuous debt. But you're not budgeting, you're being programmed. Scientists have scanned people's brains while shopping. When you see a $100 price tag, your brain's pain center, the insula, lights up like you're experiencing physical pain. But show that same brain $25 today, the pain vanishes. BNPL companies literally hack your neurological response to spending. This is called temporal discounting. Your brain treats those 3 future payments like they're someone else's problem. For thousands of years, humans survived by prioritizing immediate needs over future ones. BNPL exploits this ancient wiring. The companies understand this psychology perfectly, reducing payment friction. and minimizing checkout anxiety. They're selling psychological permission to overspend. And every company wants in, right? Traditional finance lets you borrow to buy a car. BNPL's innovation was to let you borrow to buy a burrito. Now, you're subscriptionifying your entire life without realizing it. That jacket isn't just a purchase anymore. It's a monthly service. Your whole wardrobe becomes Netflix. Each payment plan adds another recurring charge to your mental load. Now, here's where it gets dark. Consumer Financial Protection Bureau data shows 43% of BNPL users have missed payments. Look around you. Nearly half of everyone using BNPL has already failed to pay on time. 1 in 3 paid late in the past year. Among those who use multiple BNPL services, the rates are even higher. When payments fail, the cascade begins. You miss one $40 payment, the app tries again. Your account overdraws. That's a $35 bank fee plus an $8 BNPL fee. Now you're $83 in the hole from a $40 payment. One small mistake becomes a financial avalanche. When payments fail, the cascade begins. But the real trap is loan stacking. The data is staggering. 60% of BNPL users juggle multiple active payment plans. Nearly a third, 32%, manage 3 or more simultaneously. Different due dates, different amounts. It's a mental juggling act that's designed to fail. The most alarming trend shows how far it got. BNPL for necessities. 1 in 6 users, 16%, now finance food delivery. Klarna's partnership with DoorDash means you can split a $15 burrito into 4 payments of $3.75. We're microfinancing lunch. When society normalizes splitting the cost of a meal into installments, we've crossed a dangerous line. It's desperation dressed up as convenience. This shift from discretionary to essential spending reveals BNPL's true nature. But who's paying for that? While you're feeling clever about splitting payments, retailers are bleeding money. Every BNPL transaction costs retailers 4 to 8% versus 1.5 to 3% for credit cards. Let me show you exactly what this means. Take a $100 purchase at any store. With a credit card payment, the customer pays $100. The card processor takes a $2.50 fee, so the retailer receives $97.50. With BNPL, the fee is $6, so retailers receive $94. That $3.50 difference per transaction is massive. For businesses operating on 8 to 10% profit margins, BNPL fees can shrink profitability entirely. But it gets worse. The contracts BNPL providers force on retailers explicitly forbid surcharges for their users. Retailers legally cannot pass these fees to BNPL customers. So what would they do? They would raise prices for everyone. What if BNPL added to retail prices across the board? Cash customers are subsidizing BNPL users' shopping habits. But payment delays compound the damage. Credit card processors deposit funds within 24 to 48 hours. BNPL companies promise 3 to 5 business days, but frequently take longer. For small businesses managing tight cash flows, those delays can mean missing payroll or supplier payments. The Australian market gives us a preview of the coming collapse. When OpenPay failed in February 2023, they left behind $18.2 million in operating losses. Merchants who thought they'd been paid, they weren't. The money was gone. Laybuy's bankruptcy was even worse. 4,200 merchants and 766,000 customers left scrambling. One craft store owner reported losing $790 on just one transaction. Multiply that across thousands of businesses. Kiwi Bank's $30 million exposure to Laybuy sent shockwaves through the financial system. This wasn't some small startup failing. This was systemic risk becoming reality. Unlike credit card processors backed by major banks with FDIC insurance and reserve requirements, BNPL companies offer zero merchant protection. When they fail, merchants eat the losses. And it's not hard to see why they're failing. Here's the dirty secret of BNPL. They lose money on every single transaction. Not sometimes, not on risky customers, every single transaction. Let me show you the math that's killing these companies. Klarna. the industry's largest player, just posted these numbers. Q1 2024 revenue of $621 million, but losses of $99 million. That more than doubled from last year. Their workforce has been slashed from 5,000 to 3,500 employees, with plans to cut down to 2,000 using AI. Their CEO admitted they need to fire 60% of their workforce just to approach profitability. That's not optimization, that's desperation. But here's why it's mathematically impossible for them to succeed. On a typical $100 BNPL transaction, they collect a $6 merchant fee. After paying 50 cents in processing costs, $1.50 for customer service, $2.40 for fraud and defaults at their 2.4% rate, and $2 for technology and overhead, they're left with a net loss of 40 cents. These businesses are money incinerators. The funding structure makes it even worse. BNPL companies borrow from institutional investors at 5 to 7% interest, then lend to consumers at 0%. During the easy money era, investors tolerated these losses because they believed in growth, but rising interest rates changed everything. Borrowing at 7% to lend at 0% while eating 2.4% in defaults isn't a business model, it's a death spiral. The default rates hide an ugly truth. BNPL companies tout 2 to 3% default rates, but look closer. These are measured on 6 to 8 week loans. If annualized, that would be catastrophic. Automatic payments mask true delinquency until users' bank accounts run dry. Users who can't pay get blocked from future purchases, creating hidden defaults. So much so, it started to be noticed. Without interest income to offset losses, BNPL companies have only one option: grow or die. But growth is expensive. Customer acquisition costs run $25 to $40 per user. With average transactions of $135, they need multiple purchases just to break even on acquiring you. The death spiral has begun. To grow, they must approve more risky customers. More risky customers means higher defaults. Higher defaults mean bigger losses. Bigger losses mean more desperate measures. We've seen this movie before. Subprime mortgages in 2008. Payday loans. The pattern never changes. Easy credit, explosive growth, sudden collapse. The free-for-all is over. Regulators have finally woken up to what BNPL really is: credit, and they're bringing the hammer down. But first, understand this. BNPL companies structured their products to dodge the 1968 Truth in Lending Act by keeping loans under certain thresholds. Credit cards must disclose all costs up front. BNPL, they found the loophole. Less protection for you, more flexibility for them. That loophole is closing. 2024 marked the turning point. The Consumer Financial Protection Bureau ruled BNPL must follow the same rules as credit cards. Full disclosure of all fees and terms, standardized cost comparisons, dispute resolution processes, refund protections. For companies already losing money on every transaction, these compliance costs, estimated at $2 to $3 per transaction, are devastating. The crackdown is global. The UK now requires mandatory affordability checks before approval. Australia has fully integrated BNPL into their national credit code. The EU's Consumer Credit Directive now covers all BNPL services. The regulatory arbitrage that lets BNPL companies operate in the shadows, gone. Banks smell blood in the water. They're moving in for the kill. Chase launched My Chase Plan, BNPL using existing credit lines. American Express created Planet. Citi rolled out FlexPay. Apple tried Apple Pay Later, failed, then partnered with Affirm. The bank's advantages are crushing. They have millions of existing customers and can borrow at near zero from depositors. They operate with diversified revenue streams, decades of regulatory compliance, and actually profitable business models. Industry consolidation is accelerating exactly as predicted. Moody's warned, few BNPL companies will remain independent. they're being proven right. Square bought Afterpay for $29 billion, now worth far less. OpenPay went bankrupt. Lay-by collapsed. Others are desperately seeking buyers. The survivors are abandoning the pay-in-4 model entirely. Klarna pushes 6 to 24-month loans with interests. They're becoming exactly what they claimed to replace. But if consumer BNPL fails, what about B2B BNPL? Businesses are now using buy now, pay later for inventory, equipment, even payroll. The volume is staggering, expected to hit $669 billion by 2029. But when a consumer misses a payment on sneakers, they lose shoes. When a business can't pay for inventory it already sold, entire supply chains collapse. Imagine a retailer using BNPL to stock inventory, selling it, then the BNPL company fails before paying the supplier. The supplier doesn't get paid, the retailer can't restock, customers can't buy. One BNPL failure could freeze entire industries. Within 24 months, the BNPL landscape will be unrecognizable. The survivors will be indistinguishable from the credit card companies they claim to disrupt. The revolution is over. Traditional credit won. Someone has to pay for all those split payments. The question is, who? When a BNPL company fails, here's what happens. Option 1, retailers eat the loss. This is what happened with OpenPay, Lay-by, and GenoaPay. Retailers who thought they'd been paid discovered the money never arrived. $18.2 million in losses, 4,200 businesses affected, zero recourse. Unlike credit card processors backed by banks with FDIC insurance, BNPL companies offer no merchant protection. When they fail, retailers simply don't get paid for products already delivered. Option 2, debt gets sold to collections. The BNPL company's remaining assets, including your payment obligations, get sold to debt collectors for pennies on the dollar. You still owe the money, but now to aggressive collection agencies who add fees and damage credit scores. This is already happening. Failed BNPL companies' loan portfolios are being packaged and sold to the highest bidder. Option 3, banks absorb and transform them. Square bought Afterpay. Banks are launching their own versions. When traditional finance absorbs BNPL, they add what was always missing: interest rates. Your pay-in-4 becomes a credit card with extra steps. Same debt, new packaging, higher costs. Option 4, emergency bailouts. When Kiwi Bank faced $30 million in exposure from Lay-by's collapse, it revealed the systemic risk. If enough retailers and banks are exposed, governments might intervene to prevent broader economic damage. But bailouts mean taxpayers foot the bill. Your tax dollars cleaning up venture capital's mess. BNPL was never sustainable. It was a venture capital experiment in human psychology, subsidized by billions in investment money. For 5 years, investors paid for your split payments, hoping to find profitability that doesn't exist. Now, the bill comes due, and everyone pays. Retailers, through losses and fees. Consumers, through higher prices and collapsed services. Taxpayers, through potential bailouts. Investors, through worthless equity. The party's over. Traditional credit won. Or will this morph into a new kind of product we're not seeing coming? If you're interested in how tech is reshaping finance, maybe you've wondered what actually happens behind the scenes when you tap your card to buy your morning coffee. If so, have a look at this video.